In this video, traders, we're going to look at the advantages and disadvantages of joining the bid or offer or ask. Stay tuned. Hey guys, warm welcome to you. All right, so advantages and disadvantages of joining the bid or offer versus hitting the market. So something perhaps for day traders, this, even swing traders as well. You've got to execute on an instant time frame, haven't you? So this is for people who aren't just leaving resting limit orders in. They've recognized a setup, a trigger, and they want to go and enter the trade. And so instead of maybe putting a limit in, you've got a choice of, okay, do I go to the market or do I work a limit close to the market? So we're not talking about a limit that's far away and the market come back to it, because that's just a definite order that sits in here, either gets filled or it doesn't. But this is when, okay, I want to get in now. So do I just go aggressive or do I work an order? So let's have a look at the pros and cons of both. Some of them are obvious, some are not so obvious. So if we can imagine here, we've got a spread of 50 to 51, and that will be the last two digits of whatever we're trading, a currency pair, futures contract, commodity share, whatever. And we now want to go long. So our hypothesis is the market's going to go long, we're bullish, and we have a choice here. We don't want to wait, we want to get in, but we also maybe want to be a little bit concerned about price. So there's a couple of things we've got to take into consideration here. One is the speed and the momentum of the market. If the market is moving very, very quickly and it's a setup where it's just starting to go, maybe you're just trading a breakout, maybe you're trading just a continuation or some kind of momentum type pattern, then you probably don't want to be working a bid. So that's the thing we've got to look at, guys, the setup type. And that's the first thing. The second thing we need to look at for is the liquidity. Because if we're trading something with thinner liquidity, like for example, crude oil, like for example, Dow, DAX, I say thinner, I mean relative to, let's say the S&P 500, or maybe some of the bonds, some of those big thick markets, Euro stocks, another one. You know, these markets have big amounts of orders on the bid and the offer. And generally speaking, it's when the price of the instrument is lower. So in other words, when the price of the instrument is lower and the number of ticks moved is lower. So you've got something like the Dow that maybe moves 200 ticks in the day versus say something like, I can't think off the top of my head, but something that moves at say 30 ticks in the day, then you're going to get more liquidity each level because each tick is more meaningful to the day's range. That's just a general rule of thumb. So you want to look at the liquidity. So for a really thick market, then I've got to think, okay, well, if I'm trying to go on the best bid or best offer or best bid in this example, because we're going long, then I'm going to be at the back of the queue and it's going to have to trade through a lot of contracts, a lot of volume before it gets to my order. And so that might not be what I want to do. So, but if we're trading something that's a little bit thinner and the spread's kind of widening out and narrowing and we get little bits, then I might be able to work a bid and get filled on it. So we've got to think about the liquidity on that. And the third thing we need to think about is the urgency. Okay, if there's a time constraint, then we don't want to be messing around. If there's any kind of data coming out that we want to get out on, or it's coming to the close or something, yes, it's similar to setup, but slightly different in terms of the time constraint. So there's a couple of things we need to look at. So what we would do is the advantage we've got, obvious advantage of hitting the bid, of going on the bid as opposed to hitting the offer, is we're saving ourselves a tick, or in some circumstances, if the spread has widened because volatility is kicked off, we've saved ourselves 2 or 3 ticks, which over time adds up. Obviously, the disadvantage we've got is we might not get filled. So where's the sweet spot with this? The sweet spot, and also the other thing I wanted to put on here, guys, is the volatility. I'm just going to put vol here. The volatility, because if the price is kind of oscillating around and moving violently and you're reasonably illiquid, as in comparing to the S&P 500 or the Euro stocks, then you probably, 80% chance of being filled on the bid. And don't forget, if you're quick enough as well, you can bid 50. If it then goes 51 bid, so you've missed it and it goes 51 bid, you can move your bid up to 51 and you'd still be in the same position that you were before if you got filled. You'd be filled at 51. Now, of course, if it goes to 52, 53, 54, you've lost out. But if you've got decent choppiness in the market, i.e. decent volatility, and it's kind of not just plod, plod, it's kind of back and forth, but moving your direction, then the chance of being filled on the bid are probably quite high, because just general noise of the market, lots of flow, two-way flow coming, so you're probably going to get filled. Again, liquidity is reasonably low. You're not going to be right at the back of a 6,000 shares or 6,000 contracts queue. You might be 6th out of 5 in front of you, which is just a little nibble for somebody, so you're going to get filled more likely. And of course the setup, if the setup doesn't really rely on it, the thesis of the setup is immediate momentum, then you're saving a bit of time. And also, guys, there's a psychological benefit to this, and it might just be me, or maybe you can relate to this as well. The fact that you are working an order feels like you've got more control over this trade. If you're saying, listen, I don't want to pay 51, I want to pay 50, and so you're working that bid and you're working at 50 and you're getting filled at 50, it puts you on the front foot a little bit. It's, is this tangible? Does this make sense? Probably not. If it's one tick, it is what it is, and some setups you need to, but it's that control, an element of control, and it starts to trade off, and a case of, listen, I want to pay what I want to pay for it, and if I miss it, I miss it. And it's that kind of approach that really sets it apart from just wildly trading at market. I've just got to get in, I've got to get in, always having that urgency about it. It's like, no, this is on my terms. I will trade this on my terms. And whilst the tick may not be a lot, that kind of certainty and confidence that you're trading just gives you a little bit more power over the trade, if that makes sense. Now, from an operational perspective, this can be challenging to do if it's a very, very quick market. Many brokers will allow you to join the bid or join the offer. If you're trading via a spread bet platform or CFD platform, then of course you have to have your ticket ready, and most of the time the limit may well change, and you've just got to might well change with the market, or it will change if the market moves in a certain direction. But what you'll have to do is you have to just punch in your limit. So if it's really fast moving, logistically you may not be able to get that limit order in quick enough. If it's fast moving enough that you can literally just punch in the 50, put your limit in and let the market rock back, then fine. Now, I want to point out, guys, there's a distinct difference between trading on the exchange and trading via a spread bet or CFD platform. When you're trading on the exchange, you can be the bid, prices can be hitting you and you can be filled, and the bid can still be 50, 51. Just means that sellers have hit you and the bid hasn't lifted or hasn't been moved down to 49 yet. However, if you're trading via a spread bet or a CFD, to get your fill at 50, the market has to move down one tick and be trading at 49.50. It has to be the offer price for you to get the fill. So there's a distinct difference. In some markets, it doesn't matter too much. If we're kind of chopping around, one tick back, it will probably still get you the fill. Thicker market like the S&P 500, you got more chance if you're actually sitting on the order book of getting filled than the whole thing moving down one tick. So you've got to bear that in mind as well. But very similar for the kind of for the more volatile everyday markets. And so you can do that as well. So something about, yes, saving a bit of money, but I think the important thing, guys, is the control of it. If you've got control and your working limits at a level that you want, even if it is one tick to your advantage, it just puts you a little bit of an edge, just gives you a little bit of a mental edge, puts you on the front foot a little bit, and allows you to kind of take the trade going, yeah, well, I took it on my terms, I didn't just rush into it. I didn't set the scene for being rushed and panicking and filling orders. I was like, yeah, I want to take the trade now, but I'll take it at 50, thank you. And if I don't get filled at 50, I'll reassess. Pushes up a bit, comes back, right, well, I don't mind rebidding 53 because we're up to 57, we've come back. You're being a little bit more certain about your order type. Anyway, I think you get the idea. That is the advantages of joining the bid or the offer. Take care, guys, whatever you're doing, keep your risk managed. I'll see you in the next one. Goodbye.